Welcome back to the podcast. Thank you very much for being here. Guess what? Again, you guys are going to get a 2-for-1. This is going to be on both podcasts, Farming Without the Bank and Without the Bank. So normally I don't do this. I am short time this week. So we are going to double up because the subject is important to everybody. It does not matter. A lot of people are having this question and they want to hear from me about what inflation is doing, how is that affecting our policies, what should we be expecting, all that good stuff. So let's talk about it. Before we talk about it though, if you like the podcast, share it, rate it, tell all your friends. If you want them to know how crazy you are. So I had a client last week that said, yeah, my friend said that this is the worst idea ever. Guess what? Said friend is a financial advisor. Yes, that's to be expected. To be expected. Okay, so let's talk about inflation. I received a text message last week that said, Mary Jo, you should do a video on inflation. This particular person does not listen to my podcast, I don't think. But he said, you should do a video on inflation. To which my response was, just to complain about it like everybody else? I don't have a solution to inflation. So many people want to kind of pin the life insurance policy as this great inflation barrier, right? I am sorry, but with inflation being 10% plus, I mean, it just look at their numbers. I heard on a podcast last week or the week before that inflation is 11% on food year to date. So whatever it is that they're giving us for an inflation amount, I don't know that we can believe that. I know it is 10% plus. There is nothing. Maybe real estate in some areas may compete with that if the housing market holds and it does not slow down, stay level with these higher interest rates. And I don't even believe that that's going to happen with the higher interest rates. I don't believe that the housing market is going to necessarily fall like it did in 08 and 09. And if you need explanation on why that is, listen to the podcast that I did with Ken Gronbach, I believe his name is, the demographer that I interviewed. I know his name is Ken. I'm just forgetting his last name at the moment. But that podcast was awesome because we talked about the fact that we have all these millennials, not enough homes. Back in 08 and 09, the situation was very different. We had a bunch of homes, not enough Gen Xers buying. So we had an oversupply of houses. That is not the case at the moment. So I don't know that, maybe with inflation, you can keep up with housing in certain areas. Some people might say gold and silver. Can you use gold and silver? The market is not going to keep up with inflation. Our jobs are not paying more. And here is the thing. Employers, me being an employer, I would love to give my employees a raise. But guess what? Everything went up for me as well. And so employers would love to give you a raise. I heard the other day that our local McDonald's is paying $21 an hour for the drive-up window. $21 an hour. That means that your burger is not going to stay $1 whatever or $4 or whatever it is. They have to raise the price in order to get the help. It's just that simple. We are paying for it at the end of the day. The only way that they're not going to need that help is if we stop going there. And yes, we may have to stop going there with inflation at the point of where it's at. But can the policy protect you against 10% inflation? No. It could have protected you against 4% inflation. and not protect you in the aspect of like you're going to make some huge rate of return, but in the aspect of, oh, we'll have some death benefit, we'll have some protection, cash value will grow, we'll be able to sort of keep up with inflation. Nothing is going to keep up with the inflation and what is going on in this country right now, in my opinion. And maybe I haven't seen anything, maybe I haven't experienced anything, but anything that I read or listen to, I listen to a lot of Robert Kiyosaki stuff. He talks a lot about oil, gold, silver, um, real estate, those sort of things. So this is not, so many people think because we have this infinite banking concept that, oh, this is the answer to everything. It is not an answer to everything. It is a tool to help with those answers. It's one more thing to add to your toolbox. You can't do everything with a hammer. Okay. You might need a screwdriver as well. And this is the exact same thing. IBC, so many agents want to make IBC the answer, and this is the end all. No, it's not the end all. It is a tool to help with some of those things. So I wish that I could say that, oh, this is going to be the answer. The other parts of those questions are, how secure is the insurance company? Now, you all know that the insurance company, especially the one that I use, less than 0.5%, less than 1% of their portfolio is in the stock market. I think right now we're at like 0.6 or something. So it went up just a little bit, 0.6. What are they? How secure are they? Well, let me tell you, they did have to lower dividends last year. A couple companies did. A couple companies lowered dividends in 2021 already and stayed level last year. Every company has been lowering dividends. And ironically, if you look at dividend history amongst like 5 or 6 companies, they have all lowered dividends at least 9 times since 2008. I believe the statistic went back to. All these companies have done that. They all have the same pool of money to invest in. You want a company that has great vital signs, that understands where to put money. These companies are 200 years old. They know how to manage money for the most part. And I say that because we had a company, not my company, not a company I used, but there was a company in 2021 that demutualized. They were not doing good financially. I could see that on their vital signs, hence why I did not do business with them. They were already doing some things that were alarming. That was just poor management. That is why it is so important to write a policy with a company that's been around, that has good management. Just because you've been around doesn't mean that the old CEO has been around. So if we have a CEO that's not conservative, we have issues. If you are looking at an insurance policy from various companies and you are looking at the non-guaranteed side, if you're looking at the non-guaranteed side, and let's just use one of my companies for example, I'm going to look at One America, and then I might have a client that brings another policy to me from XYZ company that I will not name names. That company, their non-guaranteed might be significantly higher. How? Because they all have the same pool to invest in. They're all doing bonds. They might have some stocks. They may have real estate. And then they're going to have other things. So if we're going to have more money on the non-guaranteed side, are we over projecting? Are we putting more money at risk to earn more, which puts the company at risk? Are we dipping into reserves to illustrate that we're going to pay you more, but we don't actually pay you more, and it's a sales gimmick? Okay. If you're going to compare against companies, you have to look at the guaranteed side, not the non-guaranteed side, because companies can adjust that dividend and they can make it look fantastic. Now, the company that I use several companies, but the company that I prefer is One America, because they are so conservative that they always kind of come in almost last as far as how much they're paying out, because we want to keep in reserves. We want to be conservative and not over project that, oh, how are we going to pay all these dividends, which is part of what I saw happening with Ohio National. I could see on their vital signs, like their money was invested in all the same places, but they were paying higher dividends. So I started asking people smarter than me. I'm like, how are they doing that? How is that even possible? Well, because their investments were not really in other. They weren't in the stock market. They weren't risky investments at the time. So the only way that they can be paying a higher dividend is by taking money from reserves. Well, if we're taking money from reserves, and I don't know that this is what they did. So this is my logical thinking. If we don't have money coming in, where do we go get it? We get it from savings, right? Reserves. So what happens when that gets depleted? That should be there for the, oh my gosh, the world is falling apart day, not for just illustrating better so that we can sell more insurance. And a lot of life insurance agents will look at that. Now, there are insurance agents that do not agree with what I just said. And that's okay, whatever. I don't agree with what they said. We all do business a little bit differently. At the end of the day, we're all using mutual companies. And if that mutual company has great vital signs, I'm okay with that. There's a lot of mutual companies out there that are fantastic right now. Are they going to have how are they protecting themselves is what I look at. When I look at the vital signs report and I see a lot of money in or I see a lot of money in the stock market, I know that we're going out of bonds and real estate so that we can kind of pull money from a higher risk. Well, where is that higher risk going? Even the company that I use, they put a little more money into other, and I made an immediate phone call and said, where is this? I need you to explain this to me, because I need to understand where other is and how much is there of the portfolio. How much do we have at risk? What happens if we lose that? How does that affect the company? These are all things that are super important to me because I have my money there, right? That is what I look for in the company, to know that they're going to be there for 121 years. And a good conservative CEO understands that. So if your agent knows the CEO of the company, that's great. I know the CEO of the company. I know him. I have his cell phone number. I can call him. I can ask those questions of the financial department. I can ask all that stuff and I can get an answer in Mary Jo terminology. I mean, they're typically using much fancier words than I would use. And then I repeat it back in very simple terminology. Because y'all know, like, I am not a finance major. I don't claim to be brilliant. To me, it's common sense. And there's no reason to be using big fancy words. But some people are so smart that they just can't. Like, they don't even know my words, right? So it's Mary Jo terminology, people. It's my words. Sometimes I make up words. Yeah, it happens. I mean, everybody can make up anything nowadays. So I just make up words. So the company is important. Do I see them going anywhere? No, I don't. Because when I look at vital signs, the majority of the mutual companies I look at out there, I might look at the big five and then I look at all the small ones. One America, Lafayette, Emeritus, Penn, Guardian. Well, Guardian's kind of one of the big fives, but those four small companies, I'm looking at them. I might not write with all of them, but I'm looking at them to see what they're doing compared to the companies that I write with, because I want to make sure that they are doing the right thing. Because if they're not, I'm going to call you up and call you out on it. And you are going to have to explain to me why. Where is this money? Right. Even One America, I talked to the vice president of the independent brokerage. He used to be an actuary. And I said, what is with all this money in the market? They have like 0.6% at this time, right? They went from 0.5 to 0.6. And I said, why do we have so much money in the market? I said, I don't like that. That's not very safe. And he said, Mary Jo, we made money in the market, so we have a little more money in the market. I'm like, oh, good point. I don't anticipate anybody to make money in the market. And so it was kind of funny. Because if you're going to make more, you're going to have more there, right? The other thing to understand is that when they invest, when life insurance companies invest in real estate, they are not investing in residential real estate. They are not investing in 20 plexes and like where people live, right? Apartment type style. That is not what they're doing. They are investing in either a commercial building, a strip mall, and typically that place is going to have a grocery store. This is what I was told by the company. They're going to have a grocery store and they will only loan 40% value. So if you're going to get a loan from an insurance company, because essentially the real estate that they have is they are lending people money to buy real estate and they're holding that real estate as collateral. They're playing banker, but they are not going to give 60%. Nope, they will loan 40% and there needs to be 60% equity in that building. So they are even more conservative than a bank. And they want to make sure there's a grocery store because people always need to eat and they need tenants that are going to continually pay. There was very little real estate that did not pay during COVID that they had defaulted rent on. So that is all a good sign. That is all a sign that these managers of the money know what they're doing. It is not a typical broker that you just throw money at and you hope all is good. No. In the life of One America, now I may misspeak, but I am very certain that in the life of One America, we are on our fourth individual that is managing that money. And every single one of them has been taught from the prior. Okay. They do not deviate into new sectors. Most companies don't. That is why I said there is one pool of money. They all basically go to the same place because they all have to be there for another 121 years. They've all been there for 200 years. They are mitigating their risk by understanding health, by underwriting, all of this stuff. When a company does very quick underwriting with no blood work, that is extremely concerning to me because I have so many people under 65 that are unhealthy and uninsurable. I prefer to give my blood and do a urine sample and go through the full exam so that they know what the risk is on me. So many people kind of get upset that what do I have to do this health exam for? Why do I have to answer all these health questions? Because it is mitigating risk and it is your company. Once you own a policy, you own part of that company. For heaven's sakes, you don't want them to go backwards. So you have the health risk, you have the financial risk, you have the CEO administration risk. Is there some risk? Yes, that the company could demutualize, that the company could go out of business. What is the biggest risk of this not working? You not keeping track of your loans, you not paying premium correctly, you not understanding it. That is the biggest risk. Is this 100% risk-free? No, nothing is 100% risk-free. And people will say, well, is this FDIC insured? No, FDIC is broke, you guys. Look it up. They are broke. The banks don't even need to have any money in reserves. If you go to the bank and you want $5,000 cash, they'll probably tell you to come back in 2 days. maybe 3. They have to get that money. They are not housing money. When I used to work at a bank in college. We had an entire safe full of money. That does not happen anymore. And I'm not even that old. So there's risk. There's risk in everything that we do. This is very minimal risk if you work with a good company and an agent that understands. So I hope that answered your question. And thank you for emailing me the question, because it is a question that so many people have. I wish that I could beat inflation. And yes, I firmly believe that the insurance companies are safe. If they aren't, I'm screwed, because that is where my money's at, in addition to real estate. As Robert Kiyosaki says, diversify amongst asset classes, not within the same asset class. So real estate would be one class, right? Stock market is one class. Gold and silver are one class. So many people want to diversify within one class and say they're diversified. No, if you buy 10 different stocks, you're not diversified. If you buy some stocks, some life insurance, some real estate, maybe some gold and silver, you're diversified. So think about that when you are looking at what is the safest thing to do. Is there any protection against inflation? Well, if the feds stop printing money, which is what the infinite banking policy is going to help with, if you listen to what Nelson Nash is saying and read How Privatized Banking Really Works by Carlos Lara and Robert Murphy, How Privatized Banking Really Works. If you read that book, you will understand why infinite banking is a very important piece to getting rid of the Federal Reserve and cutting government in half. The only way to stop this is to stop the printing of money. That is the cause of inflation. And it is so out of hand right now. It is insane. Insane. Thank you for the question. Let me know if you guys have questions. I love the suggestions. Email me, maryjo@withoutthebank.com. Grab the book, Farming or Life Without the Bank. You can go to withoutthebank.com. You can go to farmingwithoutthebank.com. Whatever. Keep the suggestions coming. Keep the questions coming. I love the emails. Let me know if you need anything. maryjo@withoutthebank.com. Thank you, and have a fantastic rest of your day.